SoFi reported their first quarter 2023 financial results earlier this morning as of this recording, and while the company beat on revenue, they beat on EPS, and they even raised their guidance for the full year, the stock fell double digits in trading. So clearly there's a disconnect here between what the wider market is perceiving as SoFi's results and what the headline numbers were. And in this video, I'll be doing a full breakdown of the earnings report as well as the earnings call to try to get to the bottom of this. Okay, so first let's start with high-level numbers before drilling down into specifics. SoFi reported $472 million versus $441 million expected by analysts. This represents a 43% year-over-year growth rate in revenue. They beat analyst expectations on the bottom line as well, reporting negative 5 cents EPS versus negative 8 cents expected by analysts. Their net income dropped from negative $110 million last year all the way down to negative $34 million this quarter, and their adjusted EBITDA skyrocketed from 8.6 million all the way up to 76 million in 1 year. Now, this represents the third consecutive quarter of record adjusted EBITDA. So the company is slowly inching closer and closer towards that profitability that was promised in their Q4 earnings call. From a member's perspective, the company added 433,000 new members in the quarter and ended with nearly 5.7 million total members. This number is up 46% year over year. In addition, they added 660,000 new products in the quarter, resulting in nearly 8.6 million total products, a 46% increase on this metric as well. Anthony Noto mentioned that as a result of the cross-selling, SoFi sits around 1.5 products per members, and they expect this ratio to continue in terms of that flywheel. And speaking of that flywheel, we can just see how fantastic the results are here. Flywheel continues to increase from a financial services to lending products ratio. Now, looking at members and products, as we see the growth charts, we can see declining sequential growth rates. In other words, they're still growing, but they're growing at smaller percentages every time. Now, this is normal as companies get larger, but one other thing that's more specific to SoFi to keep in mind is that the company targets around 400,000 new members per quarter, and they're very selective about these members to ensure that, for example, on the lending perspective, that they have the highest quality members. One thing that they highlighted on their call on their borrower quality was that from a personal loans perspective, the average FICO score for a member is 749, and the average income for a member is $164,000 per year. And on a student loan borrower perspective, it's even better, with FICOs of 769 and $173,000 yearly average income per member. So SoFi overemphasizes on the quality of members, which is definitely one contributing factor that keeps their number maybe smaller than we expect in terms of that member growth. Another factor is that SoFi achieved these results while lowering their sales and marketing spend. One assumption that I'm making in the back of my mind is that if SoFi increases their sales and marketing spend, they promote this much more, and then they lower the threshold of quality for their borrowers, they can obviously add more than 433,000 members per quarter. They can manually adjust that. They can maybe have 500,000, maybe 600,000 members per quarter. However, the company is focusing right now on profitability, and they're being pragmatic about who they add and how they add them. So they're trying to have sustainable growth as opposed to super explosive growth at all costs. So when we see that 433,000 number in terms of new members, and we're disappointed because the growth rate goes from 11% to 9% to 8%, just know in the back of your mind that SoFi can manually adjust this number if they wanted to focus purely on members. But right now they don't. They're focusing on that profitability and maintaining higher quality of members as they add them. Total deposits grew by a record 2.7 billion, up 37% during the quarter, reaching 10 billion by quarter end. Over 50% of newly funded SoFi Money accounts set up direct deposit within 30 days, which is boosting debit spending. This is fantastic to see because first and foremost, this is the first year that we've had SoFi Bank since getting the bank charter in January of 2022. So we're actually seeing $10 billion in deposits in their first year. And one unique percentage that they've been tracking is what percentage of SoFi Money members actually set up deposit within that 30-day period. So this number is increasing every single quarter, which is good to see. Now, one thing that they also mentioned on the call was that 90% of SoFi Money deposits are from direct deposit members. So these are the members with a high FICO score. And earlier in the quarter, if you'll remember, SoFi raised their FDIC insurance to $2 million from the standard $250,000 insurance. And as a result of that, 97% of deposits were insured by the end of the quarter. So SoFi is not at risk like some of these other banks where their members are not insured. SoFi actually goes above and beyond the FDIC 250,000 limit to insure up to 2 million, and it's reflected in their numbers. Okay, so that's the broad brush strokes. Let's jump right now into the individual segments to understand the business at a more granular level, starting with lending. Lending products increased 24% year over year to 1.4 million products in this segment. This was obviously driven primarily by personal loans. Personal loan products increased 38% year over year, though from a products perspective, all three of the segments, home, student, and personal, saw growth year over year. Home and student were in single-digit percentages. Personal was in 38%, and so that blended out to 24% year over year. Now let's start with originations, and then we'll get to segment financials. From a Q1 perspective, total origination volume increased about 7% year over year. This was driven by personal loans. And really the main consideration here for the lending segment is the same story retold for originations as for products, as for a lot of the segment financials. Personal loans is really carrying the other segments because personal loans originations reached nearly 3 billion, up 46% year over year and over 20% quarter over quarter. Student loan volume was about 525 million, down more than 50% from pre-pandemic levels due to the student loan moratorium, which everybody knows what's going on there. Home loans declined to nearly 90 million, a 71% decrease, primarily due to the issues that they've had with their fulfillment partner and macroeconomic headwinds, right? You have rising rates, it's going to be more expensive. People don't want to buy homes when it's a high rate environment. It sort of makes sense. However, on the home loan section, SoFi also touched on the Wyndham Capital acquisition and integration. They talked more around the integration benefits that Wyndham provided them. However, since the acquisition technically closed on the first day of the second quarter, it didn't reflect in the numbers and management didn't disclose any of the costs during the actual Q&A. So we still have a big question mark around how much money did they pay for Wyndham. I think Anthony Noto dropped some hints here. He said that it was basically a deal, but we don't know the exact amounts. And I don't think we will know until the Q2 earnings call when that's officially disclosed. When asked, however, Anthony Noto did mention that the integration with Wyndham was, number one, not a significant undertaking, and that number two, the companies would integrate throughout the year. Number three, this deal would be accretive by the end of the year, so we could start seeing value very soon. And number four, Wyndham, he said, allows SoFi to increase market share gains and expects them to have a meaningful impact in 2024. In other words, meaning that we could start to see the home loan segment really start to pick up in 2024, especially as rates come down. It's more favorable from a macroeconomic perspective. Probably personal loans are going to come down and home loans are going to come up. Depending what happens with that student loan moratorium situation, student loans could also have a really good bounce back. Now, in terms of the operations from the lending segment, the segment GAAP total net income was 337 million, up 33% year over year. Net interest income growth was driven by higher loan balances and margin expansion. Q1 contribution profit increased 58% to 209.9 million. So definitely positive numbers in the lending segment. This is SoFi's biggest segment, especially in the net interest income growth. That's a really promising number, over 100% up there. And contribution profit growth is also a really promising number. Okay, moving on to now the tech platform. This is where I think a lot of the negatives of the report came into play. Tech platform accounts increased 15% year over year, but they were down actually quarter over quarter. And this obviously had some people questioning whether this is just a hiccup or whether that's the start of a trend that's starting for SoFi. On the call, Anthony Noto mentioned that they signed 5 new clients in Q1 in 2023 and that Technisys signed on a major US financial institution, which is absolutely very bullish. Now, we covered the earnings live at Monday morning earlier today, and on that call, I highlighted that the Technisys client would be much more likely to be a cross-sell from a current Galileo client than to sign somebody net new in North America, since Technisys is primarily a Latin American company. which is really bullish, right? Because that also speaks to the cross-selling abilities of Galileo and Technisys together, sharing that clientele list and increasing the intersection of the Venn diagram between the logos of those two companies. Now, SoFi was also asked about the sequential decline in accounts quarter over quarter, and they mentioned that it was just a client that was ramping off of Galileo and the accounts just reflected that story. They also took some time here to expand more on their strategy, saying that the company has made a pivot in 2022 to focus more on larger accounts that are more durable clients, and they actually get more profit from these clients than focusing on small accounts that, might have quicker lead times. They might sign a deal much faster, but they're more fickle to deal with. They might leave the platform more easily than a large client will, and SoFi doesn't make as much money on those smaller clients as they would on large institutions. So really, from a Galileo perspective, while there might be more red tape in going after a big client versus a small client, there's also more profit there, and it's also more sustainable from a numbers perspective. So I absolutely think it's the right strategy for SoFi, despite the rough patch in the short term. The technology platform segment net revenue was about 78 million. This is up 28% year over year. Now, by contrast, Galileo revenue was only up 3% year over year. The contribution profit was about 15 million, and the margins on that were 19%. And if we exclude Technisys, that margin bumps up to 28%. And just looking at these numbers, I know that the tech platform is profitable. I just don't like the fact that the expenses outweigh the net revenue in terms of that increase year over year. Expenses increased 48% and revenue increased only 28%, which obviously contributes to a lower margin. And on the Q4 earnings call, SoFi mentioned that this margin would come back to higher levels by the end of the year. So we're just waiting for that. And I think that that's the major question mark right now. They also touched on some of the products that were built on the tech platform, such as Connecta, such as the payments risk platform, both of them having increased in terms of product adoption. Finally, on the cloud migration, they mentioned on the earnings call that 100% of the transactions have now been migrated onto the cloud from on-prem. We know that this migration was something that was taking them a lot of time and effort and was contributing to higher expenses. So that migration is fully over and done with, and they should see some improvements from that moving forward. Okay, moving on to financial services. This segment has the most explosive growth rate in SoFi as an entire company, but it's also the only unprofitable segment, which management has stated that this will be profitable by the end of this year. Financial services net revenue increased 244% in the first quarter of 2023 to 81 million from the prior year of 23.5 million. So absolutely increasing really rapidly from a net income perspective. And immediately the first thing that I noticed for financial services when I saw this top line number is that revenue for financial services, this was the first quarter that it surpassed revenue for the tech platform. Tech platform booked about 78 million in revenue versus financial services 81 million. So moral of the story here is financial services is growing fast. However, financial services, like I said, it's the only segment operating at a loss. The contribution loss for this segment was 24.3 million, but this has been quickly improving because last year it was 49.5 million, pretty much double what it was this previous quarter. So they're moving closer and closer and closer towards that profitability for the financial services segment. In terms of products, they increased 2.4 million products in financial services to a total of 7.1 million financial services products. And in this chart, we can see the breakdown of products. SoFi Money, SoFi Invest, and Relay were all huge contributors to the product growth. However, all of the financial services products were up by double digits year over year. So obviously really bullish to see, because when financial services turns into a contribution profit, then SoFi as an entire company should be turning into a contribution profit very soon, which I expect to happen within the next 2 quarters. Now, from a financials perspective, I know we talked a lot about the numbers already, but obviously lending is the largest revenue driver here. I really liked how financial services is contributing quickly. Stock-based compensation expense was down about 7 million quarter over quarter. Of course, we want this to keep coming down as this is one of the main bear cases. In addition, SoFi mentioned that they lowered their sales and marketing expense. And on this point, they also expanded on the call to say that they have a 12 to 24 month lead time in terms of a payback period from their marketing spend. So basically from their customer acquisition cost, it takes them 12 to 24 months to basically recoup that money that they initially invested to get that client. That's something to keep in mind as we look into future quarters. We can look at what the expenses for sales and marketing and have that as a forward indicator for what they can expect in terms of an ROI on that spend. Cash and cash equivalents sits at 2.4 billion. Adjusted EBITDA this quarter was higher than stock-based compensation. Net interest margin for the quarter was higher than the total expenses for the lending segment, which is obviously very positive. We had positive net income from SoFi Bank. We had record levels of unaided brand awareness in the quarter, so more people are hearing about SoFi. Delinquencies are also really low. I touched on this at the very beginning of this video. So a lot of positives here for the entire quarter. Just wrapping up the video with some guidance and outlook before I go into my overall thoughts. From a guidance perspective, SoFi raised their outlook expectations. For Q2, they project net revenue to be between 470 to 480 million, representing a 32 to 35% year-over-year growth rate, and adjusted EBITDA to be between 50 and 60 million. For the full year, they expect 1.95 to 2.02 billion in adjusted net revenue and adjusted EBITDA of 268 to 288 million. Both of these are up from previous guidance. They expect 30% incremental adjusted EBITDA margin for 2023. They expect 20% GAAP net income incremental margins for the full year. And as we've said multiple times, they expect to be profitable by the end of the year. I expect them to be profitable by Q3. Overall, I think the quarter was solid. Triple beats is something that I think we've come to expect from SoFi. It's become a baseline assumption at this point that they're going to triple beat. I think that a lot of that is priced into the stock. If I had to put a number rating on this earnings, I would say maybe a 7 out of 10, 7.5 out of 10. It was somewhat of a mixed bag, especially considering the technology platform numbers. But overall, I think the business is chugging along. They're moving closer and closer towards that profitability. I still think we're very much on track to hit that by the end of the year and by Q3. Obviously, the tech platform is my biggest concern. However, the tech platform is, in my mind, a dependency on the macro environment. If other businesses, from a business to business perspective, if let's say Bank of America, just random name, they're not allocating spend towards revamping their legacy infrastructure, or they're not allocating spend towards rolling out maybe a pay in 4 solution or an AI conversational banking solution, then SoFi's technology platform is going to be hurt by that. And so a lot of this is macro related. And when you think about it in that way, it's so much more important for SoFi to focus their strategy on bigger clients because yes, they have more red tape. Yes, they have a longer lead time, but bigger clients, especially in a tougher macro environment, they have more budget to play with for the spend and they're less likely to move around different solutions. Because they have so much red tape, that's a silver lining to say that, well, it's such a rigorous process for us to even vet a new candidate. Therefore, we're more likely to stay with our existing candidate for longer. And so I think that the margins are going to come back towards the end of the year. Of course, that remains a big question mark in the eyes of investors right now. The tech platform in general, that's also why my rating was, 7 or 7.5 out of 10 and not, 8 or 9 out of 10. And obviously we want to hear more about the Wyndham acquisition, about their integrations in general. And if I had to think about some of the other question marks that remain in the minds of investors, it's around their lending segment. How will home loans ramp up? What will happen with student loans around that decision and how will that reflect in the numbers? And can financial services reach profitability and by which time can they reach that profitability? SoFi also made an announcement this morning for SoFi Travel, but that's probably going to be a separate video because I think that, we're 20 minutes into this video as of this recording. I really hope you enjoyed it. For right now, this is the Fundamentals Investing podcast. Overall, really great quarter and congrats to all the SoFi bulls. Ignore the short-term noise. I know that the stock is down double digits, but realistically, the company is executing on all metrics despite what the expectations might have been from the market out there. And fundamentally, nothing has really changed around the bull thesis of the company. They seem to be executing on their plan regardless of what happens in the stock market. Thank you for watching.